I'm Dave Stender. I'm the swine specialist in northwest Iowa, and the Iowa Pork Industry Center is partnering with the Iowa pork producers and Iowa State Extension to present this information to you. Tonight we've got Lee Schulz. He's an Iowa State University professor in the Department of Economics and an extension livestock economist. He grew up with an agricultural background on a diversified farm, livestock and crop farm in Wisconsin. Has been a tremendous asset to the pork industry. His leadership provides educational and research programming for critical problems that face the swine industry. He focuses in areas of marketing and risk management, agricultural trade, policies, animal health, production, and management issues. We want to thank Lee for coming online, and we're looking forward to hearing your market update. Lee?
Good evening, everyone. Thank you to Iowa Pork Producers Association, Iowa Pork Industry Center for having me on this evening. I wish I was kind of speaking under better circumstances, but we are in the road of recovery. I don't have all the answers or really any of the answers, but hopefully some of the information shared tonight I'll provide some ideas for you to think about as you kind of navigate these times. This picture right here, I think, really resonated with me, given the current situation, and really me being the young person here. The older gentleman asking, we didn't hoard toilet paper back in my day. We would tear out a page of the phone book or Sears catalog, and I think everyone understands that situation. But for me, being here at Iowa State, really only 8 years, I've seen a lot of things in the hog industry, but nothing like this, right? And I think a lot was said about how does this compare to 1998. I was in high school in 1998. Now, some producers went through that situation, and that's maybe like the older gentleman here. There was some things to draw on, but I think for folks like me, younger producers, maybe people within the industry, maybe the financial sector, hadn't experienced something like this. And as Jamie said, it was really, truly unprecedented. But what I think didn't get enough attention in the media, and I tried anytime that I was called, was really the resilience of this industry. A lot was talked about of how resilient or how not resilient the industry was, but really I think it was counter to that in the fact that we've seen tremendous efforts from producers and really all players throughout the supply chain to mitigate a lot of what could have been a much worse situation. Now, I think that's kind of highlighted somewhat in this graph here. These are forecasts from the World Ag Supply and Demand estimates of showing pork production. Their forecast since March until August 12th was their last forecast, and really shows here that second quarter, at the worst, they forecasted down 9% because of the slaughter capacity disruption. By August, they're suggesting 5%, and if I would have to bet on what their September forecast would be, it would even be down less than that once we got the actual data to come in. Also, we've seen in that first quarter, we pulled tremendous amount of hogs ahead. The basis levels really incentivize that. I think maybe potentially highlighting issues we could have seen with pork processing. So that maybe gave us a little bit of a head start in the industry. And then if you look at that top line of pork production forecast, to begin the year, we were suggesting up about 5%. The latest forecasts are up about 2.5%. In 2021, up about 1% compared to 2020 levels. Now, the prices really tell the situation and how it played out through the last 6 months or so. As we look at, this is the December contract. First sign of weakness in that contract was late January. And really that price has declined into February. There was a bounce back there. I think that was supported somewhat by the stocking up behavior, the strong demand we've seen. And then really as we got into issues with processing capacity, we've seen the futures drop and hit lows below $48 per hundredweight for the December contract. Considerable bounce around, but I will note here, if you look at from August to September, that's about a $6 increase, and that has direct implications for fourth quarter pricing. So looking, from a month ago to now, we're adding about $6 per hundredweight on that fourth quarter pricing. So I think that is a bit of optimism, even though prices are much lower than we anticipated this year. Now, we look at the 2020 contracts, and I just pulled up the June contract here. Really not much signals as far as buy-sell signals, but showing higher prices than we experienced here this last June. And really, I'll show later, I think these prices, we could see a considerable annual bounce back when we look at hog prices. Now, everyone had their own models of estimates, and I'll show several models that I've developed over these last several months. This one, the Center for Ag and Rural Development, back in April, we were asked to get a damage estimate for Iowa commodities. When we looked at the hog industry, and this is just Iowa specific, it was about $2.1 billion losses. And that was attributed to that January 22nd price, and then what futures prices suggested in April. And now if I reran that model here as of September 1 using actual prices, so those would be actual damages in the gray number, in the gray shaded area, and then the white shaded area would be forecast for those damages. When you total that up for the year, it's $1.6 billion. So still a tremendously big impact. It has improved since what we've seen back in April, but also I think important to understand that that's a very large impact for the hog industry. Now, as we look at price forecasts for 2021, several of these forecasts suggest a considerable bounce back in prices. And I highlight three forecasts here: the Livestock Market Information Center, USDA, and then my own forecast. I can only speak for how I make my own forecast. I use futures prices adjusted for a historical basis. And noting here that my forecasts are a bit more optimistic than maybe the USDA and the LMIC forecast. Now, I will give the other institutions benefit of the doubt here that I had the benefit of time, right? We've seen that $6 increase since the beginning of August. You go back, LMIC was making those forecasts in mid-August. So really here showing that, yes, we're going to see declines in the fourth quarter as we enter that, anywhere from about 10% decline, as I'm suggesting, the futures market suggesting, to even maybe about a 20% decline, what USDA. Importantly, too, as we get into 2021, significant rebound regardless of what you look at from a forecasting method. So futures base is about a 16% increase, gets us back to about what we had seen in 2019 prices. A little bit less as we look at the other institutions' forecasts. To put a bit of a longer term spin on this, I like to use longer term projections from USDA and then the Food Ag Policy Research Institute out of the University of Missouri. You'll see the timing of these forecasts are really important because USDA didn't have the benefit of knowing that COVID was even going to happen. They initially made those forecasts back in November of 2019, and then they released them in February. FAPRI came out with theirs in March, and then an update in June, and then another update in August. You'll see here there's very much differences, and it's the COVID, big part of that's being the COVID impact. With prices, that blue line, kind of the most recent update in those long-term forecasts. So a slow recovery, maybe think of it as like a U-shaped recovery, that 2020 hits that low, we're going to slightly increase for prices in 2021, and then increase more substantially in 2022. And then maybe kind of even out in those prices in that $65 per hundredweight range for an annual average. Now, I think it's important to understand a bit of the impacts of COVID because I think there is some concern as we get into the fourth quarter if there's additional flare-ups, how that could impact prices. Early on in the pandemic, me and Glenn Tonser at Kansas State University put out a study to look at how does capacity utilization impact hog prices. So an increase in utilization or a decrease in capacity. We found long-run averages, 1% increase in utilization or decrease in capacity decreases hog prices by 1.82%. And so you see if I multiply that by 10, 20, 30, 40, it gives me how much those prices could potentially decrease. Now, when we initially did this study, we didn't anticipate that 40% decline. But that's in effect close to what we had seen. But what you'll see is when you look at hog prices overall, and I purposely make this graph very messy because I include all the possible prices here. So negotiated all the way to the other purchase arrangement, a total weighted average, and then even futures prices in here. As has been shown by other speakers prior to this, the negotiated prices were the ones that were driven down the furthest. We did see at the height of it about a 60% decline in those prices. Futures prices really led this situation. They spiked earlier in March and helped us kind of pull some hogs ahead, and then they declined much quicker as we got into late March and early April. Now, overall, for the year to date, we've seen about a 16% decline on those prices. Now, as we look at what we lost in capacity, I like to use a pretty simple metric of just comparing the 2019 levels. It's going to be a little imprecise because we were going to expect to slaughter more hogs this year than last year, but I think it provides a good benchmark, and it also is a good way to compare across regions, because in a little bit I'll show you looking at that backup in hogs potentially by region. But as you'll see here, I show the U.S. as a total, which is the blue line, and then we also have the red and green lines where Iowa producers would predominantly market, or producers from those regions would market into Iowa, for example. And then Region 4 and Region 8, USDA does not split those out for confidentiality reasons, but what is really important in there is North Carolina. And so you'll see there that Region 4 and 8 had the largest decline and currently is below year-ago levels. Now, if we translate that into a cumulative head change since the slaughter disruptions occurred, I think speaks to a little bit of the backup situation, both nationally and regionally. I use barrel and gilt slaughter data here. It's available through August 15th. You'll see that year to date, or since April, we've seen hog slaughter or backup, you could think, so less slaughter of about 1 million head of hogs, 973,000 nationally. Now in Region 5, think of the Eastern Corn Belt, we're actually ahead of a year ago. And so that would suggest there's not much backlog there, if any at all. The green line, there's about 280,000 head. That would be here in Iowa, and then big Western Corn Belt and south of us. But importantly, if looking at Region 4 and Region 8, and if we assume Region 4 is about the same as a year ago, or Region 8 is, you'd say Region 4 and predominantly North Carolina has that backup. And I think that's what's been a lot talked about, at least in the media, and there's a lot of anecdotal evidence that that's where a lot of that backlog exists. So aggregate, it's about 1 million, but I think it has important implications of that regional backup. We scale it down a little bit more. I have an Iowa model here that actually takes into consideration capacity and actual slaughter levels. My model would suggest about 125,000 to 309,000 to give you a bound on that for the week ending 8/29. Now, I think there's a lot of evidence that we're pretty close to the 125,000, and to give you a sense of volume, we slaughter in Iowa about 150,000 to 159,000 head per day, and so, per day, and so that's not much of a backlog really at all when you're looking at the grand scheme of things. Now, as you look at hog weights, a big surprise occurred, and I even pasted in here the actual report, or part of that report. We actually had hog weights here in the Iowa, southern Minnesota, South Dakota reporting region below year-ago levels for the first time since April, and actually 2 pounds below year-ago levels. I think that surprised at least me, where there was a lot of anticipation that we would not see hog weights lower than a year ago. So again, another indication that that backlog, if it's not cleaned up, is getting cleaned up rather quickly, given the weight situation that we're facing. Now, I think it's important to talk about packing capacity as we get into the fourth quarter, if there's any additional challenges with the backlog. This is USDA data on federally inspected hog packing plants, and it shows you that the most plants are actually really small plants. So 396 plants are 1 to 999 head per day. They slaughter 125,000 head per year. And so when you work out the simple math, it's about 1 head per day. When you look at the hog plants that slaughter over 3 million head per year, those are the plants that are slaughtering about 19 to 20,000 head per day. Now, when we think about how this backlog developed, and this has implications for much longer term as we think about structural change in the industry. So when we lost 40% capacity in one single day, that's about 200,000 head of hogs. So about 510,000 is our capacity. I rounded to just make some easy math. Well, if you do that for 5 days, it's 1 million head. So that adds up pretty quick, right? Well, can these smaller plants absorb those hogs that are left on the market? And that's even if they have space. Now, we know a lot of these were booked out through 2021, and so potentially they didn't even have the space to take them. But if we think about losing a plant that slaughters 20,000 head per day, well, could a plant that does 200 head per day, how long would it take for that to eat up that volume? Well, it's about 100 extra days, or you need 100 brand new packing plants. So a lot gets talked about the economies of scale when you're talking about packing plants, and those economies of scale allow them to spread costs over more units, and they can do it cheaper. You can deliver product to consumers at a very competitive price. But when you have a backlog, the abilities of scale are just as important. We look at monthly non-federally inspected slaughter. So this is state inspected slaughter, custom exempt. There we can do about, on max, I would say about 70,000 hogs per month. And that's currently what we did in July. I think there's really a maximum on that just given the infrastructure that those have. On-farm slaughter is even lower. It's about 76,000 head per year that can be done. Now, there is still challenges at the packing plants, and I think this slide really highlights that situation. So this is boneless ham prices and bone-in ham prices, wholesale prices. Now, usually there's about a $60 per hundredweight spread in this, and that accounts for really the labor to do that. Well, that spread right now is really historically wide. So that suggests that there's still issues at the packing plants. We may be up to 95%. But we're not fully up to 100%. And because of that, I think there's been some simplification in that fabrication process, and that's starting to drive a wedge between boneless and bone-in products. So I think this is maybe a kind of a barometer to watch over time of any further challenges that are occurring at packing plants. Now, many of you have probably seen a picture like this of where the packing plants are located. Obviously, they're located here in the Midwest. And I think the next slide really highlights the challenge that COVID really presented, and a broader challenge and constraint to production agriculture and I think meat packing in particular. So if you look at the state of Iowa, for every 1,000 jobs here, over three are in the meat packing industry. If you scale it down even a little more to the Sioux City area, so Iowa, Nebraska, South Dakota, every 1,000 jobs, there's 15. So if you have a pandemic like COVID that impacts the labor supply, and you're already operating at historically low unemployment rates and people available to hire rates, that's going to cause a tremendous issue. when the pandemic not only impacted workers directly, but indirectly, and that was the main constraint on operational capacity. And that's going to continue going forward. So even though, we've kept the plants open, we've had some engineered controls in there, really the labor supply is going to be the dictating factor of how large these kills can be in the fourth quarter and as we go into 2021 and potentially further issues as it relates to that. Just to highlight here, and I want to point out kind of the three last bullet points here. I think there's been a lot of calls for changes in the industry. Not surprisingly, one's being automation, more cold storage, number, size, design of facilities. But I think we really need to appreciate what is the driving factors that put us here to date. So if we have a once in 100 year event, do we want to make drastic structural changes to the system that has developed and perfected over time? So it's really weighing this balance between efficiency that we really squeeze out of the system and resiliency. So could there be more resiliency? I think potentially. There's a lot that was learned here. There's already more resiliency in the system, but to not overly use the phrase, you don't throw the baby out with the bathwater. I think that very much applies here. Talk a little bit about inventory levels here. Going back to my longer term projections, very wide estimates on this. Not surprisingly, USDA is very bullish a lot of times on their long-term projections. FAPRI's a little bit less bullish, but I think the recent forecasts out of FAPRI are really kind of highlighting the situation that we're currently facing. That 2020 could be this peak in this current cattle or current hog cycle here, when we start to decline inventories going forward. Now, we got some early indication of that as we looked at the breeding herd was below year-ago levels. It's been below year-ago levels for the last several quarters when we look at the state of Iowa. Farrowing intentions came in about 4% below year-ago levels. I think those may be a little bit out of line given where the breeding herd currently is, but it shows obviously less optimism in the industry. We continue to see increases in productivity, even though this last quarter was pretty par to year-ago levels. So we need less sows, I think, going forward if we continue to maintain the productivity. The big thing here in this last hog and pigs report, which will get updated in a couple weeks, is the market hog inventories. And so highlighting there, the 180 pounds, those are really worked through by now. In the system, we're working through the 120 to 179. And then as we get into those lighter weight inventories, you'll see that they're much lower than year-ago levels. Now, the backlog certainly drew out into some of those levels. And so it's a little bit difficult to understand the exact timing of those, but there is some relief just from a sheer size of the inventories going forward. USDA, very, very great move from them, put out a paper before the hog and pigs report to say what the numbers tell us, what they don't. And I highlight that here because the numbers, if there was any euthanasia, anything like that, which I think was very modest relative to earlier anticipations, those aren't included in the hog and pigs report. Those numbers will get death loss of weaned pigs in 2021 in their annual report. So right now we can only really make some conjectures about the size of the pig removals in the industry. Now we know that health incidents or swine disease, typical swine disease incidents have been really low. It's the fuchsia line in there. It's a little difficult to see, but it's one of the lowest lines when we look at PRRS and PED incidences. So we've seen a rather healthy situation here. I think that's expected to continue into 2021. Now, sow slaughter is kind of an interesting case because this obviously impacts the size of that herd. Sow slaughter to begin the year was about 8% above year-ago levels. Year to date, we're about 12% above year-ago levels. But there's some anecdotal, and these are just rumors that I've heard, that The sow slaughter, we've seen some barrels and gilt showing up in here. And I think some of the levels that we've seen, especially in the Eastern Corn Belt region, where we were upwards of 40, 50% above year-ago levels in May, is maybe indications of that. Now, you don't need a whole lot of those animals to show up in sow slaughter to get you much larger numbers, because sow slaughter is pretty small in comparison to the total hog slaughter. So I think some of that could be going on and maybe mixing up a little bit of the signals that we're seeing as far as hog slaughter levels. I point out here sow farrowings and farrowing intentions because, remember, those sow farrowing intentions for the next 2 quarters were 4% below year-ago levels. USDA has consistently come in at much higher levels of actual sows farrowing than what those farrowing intention numbers suggest. So if we're just going off of what the trend has been, I would suggest that those numbers are going to come in higher. Now, some of it is because they're not adjusting the litter rate, and so they got to get the increased pig crop somehow, so they get it through the number of sows farrowing. But regardless how you get there, it's going to give us potentially a larger pig crop than what the current estimates show as far as those farrowing intentions. Pig prices have rebounded, and I'll note here that cash prices really have rebounded the most. They're pretty close to actual year-ago level and the 3-year average. Cash prices are going to lead. They're going to lead on the way down and typically lead on the way up. So here's another indication. Again, that $6 increase in the futures price, 2021 prices have held. That's brought up cash prices of pigs. I think this is going to be a great barometer really to watch as we get into the 4th quarter. Can we maintain those levels that we've seen the past couple of years? I think it'll really provide a lot of optimism in the industry. Now, what's all this mean? Put this all together, 2020 is going to stick out, obviously, for a lot of reasons, especially when we look at profitability. This is the ISU model. It assumes no hedging here. It's just a kind of a cash-based model that we put together. About a $17 to $18 loss on average. At the worst of it, it was over $50 per head loss, what we've seen some producers facing. And now as we transition into thinking about 2021, there is some profit potential out there, about $2 to $3 per head, as the futures markets are currently suggesting. Now, I want to take a bit of time to talk about the situation for packers and highlight just some things that I had heard throughout this situation and implications for going forward. So as we look at the weekly hog and cutout prices, so this is what's commonly referred to as a marketing margin or a price spread, you'll see that this price spread kind of paradoxically got pretty wide, right, in May. When we've seen less shackle space, so the demand for hogs declined, and you've seen meat being rationed because we were supplying less pork, because fewer hogs are being slaughtered, and the cutout prices increased. Well, we see a spike there in March when we had some of that stocking up behavior. And then in May there, you see the large spike in cutout prices. Now, if you don't know any other information and you know a hog weighs about 280 pounds, it'll be about 215 carcass, you'll say a packer's making $100 per head in May. But that's not really, it's not that simple. So I think it's important to kind of break these down and look at the sensitivity of these packer margins. So what I just described to you was as a packer gross margin. Just the value of the carcass plus the byproduct minus the value of the animal. And I'm being fair here. Some may use the negotiated price. That's going to make it even wider spread because we know negotiated prices are a lot less. The negotiated volume is 1 to 3%. So I'm going to use the total weighted average of all hogs sold. Now the net packer margin, you can make that calculation. You take into consideration capacity utilization, variable and fixed costs. There's been some estimates I've seen out there. It's anywhere from $25 to $30 per head to slaughter a hog to cover all those fixed and variable costs. To be conservative, I'm just going to assume 25 and split it 50-50. Now, we know that costs increased during COVID. with provision of PPE, paying overtime, putting in engineered controls, all of those things. I don't know what those costs are. I'm just going to kind of conservatively assume $2 for fixed, $2 for variable. It could be higher, it could be lower. And then let's look at like an integrated net margin. So what if I have ownership of those pigs? So I can maybe produce those pigs cheaper sometimes, but maybe it costs me more to produce those pigs sometimes. Well, you'll see as expected, that margin, when you look at it from a gross to net, goes from about $100 to $67 down to about $64. So still historically large margin, but not as large as just looking at a gross margin. I think equally important here, probably more important, is to look at current packer margins. Current packer margins are rather thin when we compare it at least to earlier this year and at times during the past. Now, they will improve in the fourth quarter as they typically do if we see seasonality persist in cutout and hog prices, but there isn't a huge margin right there that packers on average are likely receiving. Looking at it from an integrated approach here, you'll see that it's actually even worse situation because hogs are relatively cheap right now, and especially if you look back in June and July, those margins potentially were negative to now where they're in that similar range between, I think, about $5 and $15 per head. So what drove a lot of those margins, and to be quite honest, prices for hog producers, if you had formulas tied to the cutout, was the cutout rally that we seen in May. And then equally, the cutout when it plummeted in April and then plummeted into June, July, and is now kind of steady to about year-ago levels. Now, I think it's always important to break this cutout out to see what's really driving that. And that would be the right graphic there. So I break down the percentage of each primal and then the value that's contributing there. And that value can be positive or negative compared to a year-ago levels. You'll see right now that the butt, the picnic, and the belly are drawing that down compared to year-ago levels, while the other primals are drawing it up. Now, really, that cutout has been the plight of the belly. And so as we look at the belly primal, that looks exactly what the cutout did here earlier in the year. We've seen that massive spike in the cutout, as well as the depreciation in April and then later into June and July. So I think there's always a concern when you're talking about setting value of hogs based on the cutout. It's important to know how that cutout is derived and what could impact that cutout. So an example being, we know that bacon is mostly eaten at food service and hospitality, right? When you had a situation like we had seen in March and April with the closure of that food service, you've seen that really drive down cutout prices because that does drive the values a lot of times. Now, it equally, I think, helped when we looked at May prices, but the belly wasn't the only one driving that. We've seen a lot stronger prices overall. Longer-term projections out of FAPRI kind of tell the story of maybe a little bit more optimism from June to August potentially, and a sign of maybe quicker recovery, going from maybe that U shape to more of a check mark kind of shape in that recovery of value. So maybe getting back to 2017 cutout values by 22, 23 potentially, as opposed to more flat line in that $80 per range. Now, retail prices kind of follow that similar story, potential appreciation there. It'll be interesting how much of those higher prices can be pushed off to consumers and how much that impacts their per capita consumption. I'd like to finish on exports because this is a big part of the story. We know that with hogs, be it anywhere from 25 to 30% exported, value potentially even higher at times. Here's the export story when we look at the most official data. So this is looking at data out of USDA, breaking it down by year-to-date quantity and year-to-date value. We have this through June. You're going to see here in June that's a lot of reflection of those higher prices in May. And that's impacting both the quantity that our customers bought and the value that they bought. So they bought less, so overall less value when we compare it to year-ago levels. Down 3% by volume, down more by value. But overall, exports have been tremendous this year, up 24% by volume, even more by value, 29%. Obviously, China's a big one driving that, up plus 200%, both by volume and value. Now, I think as we look forward to exports, there still is some optimism. So your outstanding sales, that's what's on the books. It hasn't been necessarily shipped yet. It could be canceled, but a lot of cases it makes it to port, right? And they're overall 2% higher. All our major countries are above year-ago levels. But we get down to China there, and less is on the books than we had year-ago levels. That doesn't mean that they're not going to buy more. We know with the phase one deal, they need pork. With ASF still going on there. But I think maybe a few chinks in that armor potentially as we look at that. But overall, very strong export values. Total commitments to date up 40%. Now, what are some headwinds to some of these exports? I think as we've seen with Mexico, certainly the value of the peso relative to the value of the U.S. dollar, really it has strengthened, but early in the year we did see devaluation there. Brazil, with devaluation of their currency, they are very competitive on the world market. So that's impacting us, obviously. Australia has actually been a big buyer from the U.S. because of their stronger currency. Canada, we've seen some strength in their currency as well. So that allows them to buy a little bit potentially. Longer-term projections here, really the purple and blue line lay on top of each other. I think kind of giving us maybe a bit of a consensus that 21 could peak a little bit in export level. I think the red line there is the very optimistic story, and we continue to export. China continues to be a leader on that. The FAPRI estimate, the yellow line, is maybe the more pessimistic one in that situation, that the ASF situation gets cleaned up much quicker. We don't get a huge part of that market share. You see a lot of economic troubles worldwide, and that has a much bearish look on the outlook situation. Now, obviously, this is impacted by our production as well. And if we're going to have lower production, that's certainly going to impact exports. And I think that brings us from that red line down to those purple and blue lines. My final slide here, I just want to highlight the value of exports, because as the situation was unfolding, like many others, I received many calls from the media and many questions of, if we have tight supplies here in the U.S., they like to use the word shortage, but that's wrong. Nothing was artificially holding the price of pork down. We did see prices increase, that ration supply. We never ran out of pork. Maybe we lost 40% of capacity, or almost down to 50, but we still had 50% of capacity online. We've seen tremendous flexibility in the system. But the question was, why don't we just stop exporting for a time being? If we're exporting 20 to 30% of our production, well, that's the way that we can get that product back. Well, that's the very naive response or naive question to that, is because we know a lot of the products that we consume here in the United States aren't like products that we export to our key export markets. You look at byproduct values, you look at a lot of cuts, a lot of production of hams here comes in fixed proportion. We can get a lot higher value on the world market, Mexico in particular, for that product. So that really supports values there. And so there isn't a quick transition. And also the relationships that have been developed with our key export markets. Japan is one. You look at it from the 1980s to now, what that market has become for the United States. That doesn't happen overnight, right? That's a lot of developing relationships, proving we have a high quality, consistent product, and we can continue to deliver that product no matter what. And that's what we continue to do. We showed that we can do that. If you look back at April, hog export value peaked here as U.S. Meat Export Federation calculates. It was worth $72.50 per hog. Well, the value of a hog in April, unfortunately, was about $121 per head. That's 60%. So if we didn't have the export strength that we did in April, think about what hog prices would have been. Now, that's fallen notably in June is the latest data that we have, but that still supported values considerably to what they could have potentially been without that export market. So, exports are a huge part of this story and can really, I think, help us and pull us through a very difficult situation like this. So with that, I'll highlight here a couple of websites that I routinely update. A lot of the information that I shared today is available on these websites. And I'm always available via phone call or email to help answer any questions that you have, as well as take any questions right now.
Thank you, Lee, for the presentation. Appreciate it. Good information. And we have some questions coming in on the chat and also in the Q&A. So as we go through these questions, feel free to keep typing your questions in. Let's go back to the oversupply numbers. And the question was, you have any thoughts about how many pigs might have been home slaughtered or slaughtered in small lockers? Do you think that number could be higher or lower? What kind of range do you think you might be there?
Yep. So good question. I think some of it is, I think we'll probably be able to tally it all after this is all said and done as we get more kind of official data. I think this highlights some of it here where, we slaughter notably more. If you look at hogs or cattle, this would be state and custom exempt types of slaughter. So this would be the ones where, I think we have a lot of confidence in this data that, yes, this increased notably, but also realizing that there's kind of a fixed number on this as well. Because just like the constraints that large packing plants had, availability of labor, just the cooler space, all of that's going to limit a lot of these packing plants too. The on-farm slaughter, that's a lot more of a residual one. That's a lot more difficult to really get a handle on. I think we're going to learn after this situation. I think that network for finding hog buyers and homes for this port was much larger than we knew before this, right? And that's even more, that just highlights some of the flexibility in this system. And I think you'll see a lot more local, the buy local movement, it has gotten a lot of attention now. I fully believe you'll see more of that going forward. Now, is that going to be a large percentage of the hogs or large percentage of slaughter? No. But I think for individual producers and individual buyers, that's very important now. And that'll come as part of that resilience in the supply chain.
We have a question about where the demand is coming from. The restaurants aren't 100% open right now, and we're coming into Thanksgiving, Christmas, New Year, holidays where there's a lot of eating out typically and parties and that sort of thing. Your comments about the mix of where the meat's going now, retail versus restaurant trade, and the bacon is kind of part of that too, right?
Exactly. So I think a couple things to really note here, and I maybe I did. So if we look at so these are retail prices, and the data is through July. I think August would be similar. You'll see that really prices for bacon, for example, were pretty flat. And when you look at the AMS data, which is really the featuring, so the ones that are on sale or are featured in circulars, that actually seen a large decline in May as we would expect. So you're going to get demand by lower prices, right? So now I can afford to buy more bacon if it's offered at a lower price. Now, if you look at pork chops, for example, those prices actually surged in May as more people were buying at home, went to pork chops, for example, here. But even there, you're seeing, I think they didn't increase at the pace that the wholesale values increased. So that suggests to me that retailers ate a lot of that potential margin that they could have gotten. And so that did help with some of that demand. As those prices, yes, they did escalate, but didn't escalate quite as much.
I have a question kind of related to the labor shortage, and you mentioned that they're not boning out hams, and so you got a lower value bone-in ham product. Will that affect the cutout?
So it's a collection of all these yields, right, or all these primals. Now, here, this is really important to understand so the cutout, it's a value, it isn't a price. And so these yields are all fixed by USDA, and they update them every year, so they try to keep them up to date. But every individual packer doesn't cut a carcass the same way, right? And so these yields aren't going to be the exact same for an individual packer. Now, that's even more true in a situation like this, where you're seeing impacts to the fabrication process because of the labor situation that we're facing. So yes, I think that has implications for some of these cutout values, but understanding that these are all weighted averages. So the hams, for example, when I updated that slide today, it's a laundry list of ham products, right? And so I think some of those changes that are going to be made aren't going to impact the cutout as much as we may anticipate, because remember, that's a huge weighted average across a lot of pounds of pork each and every day, and when you aggregate that up to weekly, that's even more pork too. So yes, I think it has some impacts, but certainly not as large as impacts that we're overall seeing just in belly prices versus loin prices, for example.
The question about packer margins, and we've been running Saturdays really hard since May. What do you think about Saturday? Do you have any thoughts about Saturday slaughters going into the fall? Will they keep the labor force, and will the margins be enough to be able to incentivize people to come in on overtime, that sort of thing?
Yeah, so that's really key, and I think part of the cleaning up the backlog is very important to that story, right? Because the quicker this backlog could get cleaned up, the potentially more you can back off on those Saturdays. One, to save potential on paying that labor, but also just save the workforce for a potential purge here as we get into the fourth quarter. So I think we've seen Saturday slaughters certainly fall off from the significant high levels that they had been. We were almost running full days, not quite, but it was typically it's about 0.4 of a day. I think it was up to 0.7 at times on Saturdays. Those have come down significantly, but I think that's equally important to gear up for the fall. Save money, but also let the workers have a break, right? As we get into fourth quarter potentially, because we know it would cost more, but that's the easiest way to increase operational capacity is to work Saturday. That's kind of the natural flex built into that system. Now, also important there too, and we've seen this in the past, is October can be a really key month in that to pull hogs ahead. So, that's maybe not something that's really talked about now, because I think, there is a backlog, at least in some parts, that exists. But if basis levels get strong enough in October, that's a key incentive to pull hogs ahead. And so we've seen that in the past when fourth quarter capacity was potentially going to be an issue. We've seen slaughter levels really pick up in October, and that really helped what the situation could have been as we got late in the year. That's very analogous to what we've seen in March. We've seen a real ramp up in slaughter that helped mitigate what could have been a much worse situation in April and May.
Going back to exports a little bit, you looked at FAPRI, sort of some FAPRI projections and things, but what's your thoughts on us remaining a low-cost producer and dollar exchange rates going into kind of longer? So
here is, it's an international benchmarking group I belong to. We're just finalizing the 2019 data. This is 2018. But this shows you our competitiveness, right? So this is total cost of production. Every year, it's a battle between the United States and Brazil. Some years it's us, some years it's them. Canada's always pretty close. But that shows us really our competitiveness into the world pork market. And even some possible gyrations in currency, we still have that competitive advantage, right? So yes, we've seen here as we look at currencies, potential or what has impacted us as we look at our major competitor, Brazil. Yes, if we're at par on cost of production, well, their currency kind of devaluation relative to us, it's not great in their country, but it's great to be an exporter in that type of market. So, but also Brazil's not in every market we're in. We're not in every market they're in either. So it's also about market access and gaining market share in particular places as well. One thing I want to highlight here and I purposely put a really messy graph with all these numbers because this is an impressive portfolio, right? So think about a situation where product flows to the highest valued marketplace, right? Now, COVID is a situation that impacted the global market. But even so, we have a huge portfolio to draw upon as we find that highest valued marketplace. Yes, right now, China is a big part of that. But also there's some high value markets out there for us that allow us to get much higher prices for our product than we could get in the domestic market here. So this is a very natural hedge on that demand picture as well, just having this very good portfolio.
There's a question, Lee, about the floods and the dam breaking in China. Do you have some insight on that and whether that's going to affect us or them in any way?
Yeah, so the folks I've been talking to, and I'll admit, I'm probably not as up to date on everything or know as much, but what I've talked is it's just a factor that everyone's watching really closely. That it hasn't broken yet, or at least it hasn't hit the airwaves if it has, but it's something obviously that everyone's watching. So it's potential market mover if something happens there.
Isn't that China would need more meat? Is that what if there's a disaster over there potentially?
Yep. Now, all else equal, right? So I mean, and that I think really highlights the situation here is even when we were looking at slaughter capacity impact on prices, everything isn't all else equal now. So, again, the words are overused, but unprecedented, unparalleled. It really makes it difficult from an analyst standpoint. And I don't ever feel sorry for an analyst. That's not what I'm saying. But what I'm saying is, it's difficult to use historical relationships to project what's going forward. So that margin of error is a lot wider today than it was in the past. So if you took analyst forecasts with a grain of salt before, it's a much bigger grain of salt right now because of just we're really outside the bounds of what we've seen historically.
Yeah, going back to our small packing plants and on-farm slaughter, there was a comment that just one state, the small plant inspected butcher shops harvested about 6,000 more pigs than a year earlier. I mean, that's just one state.
Yep.
Small. You multiply that by 50, you start to get a few of those numbers back.
Yep. So, and I don't want to downplay the impact of those. And so, that wasn't my purpose there. So for an individual producer or even a system potentially, finding those alternative outlets was huge, right? It was the difference between no price and finding a price, even if that price was lower and it cost me some trucking to do that, right? But I think to highlight here is a resilient system has that, but it has the efficiencies of size and scale and abilities of size and scale too. So it's really matching that system to be very resilient in there. So, the question is, do we need additional capacity? I think that's certainly debatable given what we expect the size of the herd to be. But also when we talk about that optimal capacity, I think equally important there is the regional capacity, right? Are they located where the hogs are relative to the population, all of that. But also, understanding what that labor force is too. Because if COVID showed us anything, that was the big impact, right? So where are we going to find a labor force if that's the big constraint in the industry? There, it didn't matter about shackle space. We had enough shackle space. We just didn't have the labor supply to operate those plants for a short period of time.
Thank you. 40 producers produce 65% of the pigs, and if we're downsizing because of some losses, you think it's going to what's the mix? Is it going to come from any of those kinds of producers, or is it all going to be smaller than that producers? Where we're seeing sows numbers drop.
Yeah, that's a good question. I think it's maybe a little bit early. Now I say that certainly because I'm not privy to a lot of those discussions about what's going on. I mean, I think some key decisions are certainly being made in the industry. But I say that from a sense that, if we look at where current prices are relative to what expectations, and I say expectations from the futures market in 2021, that suggests a rebound in the marketplace. So if I was able to get through this situation and get through it through the fourth quarter, there's potential there as we get into 2021. So how that all shakes out for the size of the herd, and I think there's certainly going to be some ownership changes now. At what size and what level, that I probably don't have a good answer for. But I think it may be a little bit early, at least from my standpoint. But I miss things a lot of times too late anyway. So. But we're in a really, remember, we are in a recovery right now. I think it's just what is that trajectory of the recovery that we're going to see. So
we have a question asked you to look into your crystal ball for the September hog and pig report, and if you're a producer looking at that, what would be numbers that would be like bullish or bearish? What kinds of things would you be looking for in that report?
Well, I'll admit I didn't do my homework on this one. I usually try to do some pre-report estimates, but didn't do the homework there. One thing I'm really looking at in this report, and it kind of piggybacks off of what we just talked about, it's that breeding herd, right? So do we see a breeding herd that potentially matches up with those farrowing intentions? And so if we see the decline in that breeding herd, that's a potentially bullish sign, right? We're seeing the cutback there. I don't know if the sow slaughter numbers dictate that quite yet, the mix of, if we did catch some lean hogs in there, but that's obviously a potentially bullish. If we don't see that number move all that much, I don't think it's that bearish either, because that has much longer term implications. Really, it's going to look at the market hog inventories. It's going to give us all another opportunity to update our backlog number right here and see what's still in that pipeline supply. What is really key there is remember that that's September 1 inventories. So the 180 pounds and over, in a normal situation, those will mostly be worked through already by the time that report comes out. It'll go a couple weeks into June or into October potentially. So it's really looking at that and looking at the 120 to 179 category. What could be really bearish there is if those numbers show what they showed here in this last report, right? That maybe they're catching still a backlog out there. Now, that's something we can, I think, really rectify or look at the slaughter numbers. So USDA has a chance to do that, but that's obviously the potential real bullish one there, or bearish, or potentially could be bullish. We're also, I think, looking at that pigs saved per litter. Really, this is an aberration here. That number had been up 1 to 3%. It was pretty much at par. I think there's some reasons for that, but do we see an increase in that number and pair that with a smaller breeding herd? That still gives us a still pretty big pig crop. So that's kind of my take on that. I think there is some potential to be a bullish report, though, given what we've seen so far in some of the slaughter numbers.
Okay, the last couple of questions kind of feeds off of that. If you wanted to look at the bright side and say, okay, what would cause an independent producer to have some hope or a crystal ball to know, if you see this thing happening, it's going to be good for next year, that kind of thing, a crystal ball on an upbeat. And then the other question kind of related to that is, do you see any new markets potentially being developed, such as like India, or, and if that would develop, how long would those markets take to get into place?
So what am I watching? Well, already we got some optimism as we look at that beef contract, right? So we've gained about $6 per hundredweight. What am I looking for? Do we start to see some movement in 2021 contract? Right now, they've been fairly trading flat at higher levels than a year ago. But remember that we're gaining a lot back of what we lost this year. So if I start to see some movement in those futures prices, now those potentially could lag the actual optimism in the industry. So another thing I'm watching is right here, pig prices. So how optimistic do producers actually feel in this marketplace? Because if you go back to May, June, and July, you could buy a pig for about $1 at its low. So these were averages here. On average, it was about $4, but they were selling some for $1. So it showed you how much optimism or lack thereof was in the industry. Now these prices have been leading a little bit in the market. So if we continue to see escalation in these prices, I think this could be a real leading indicator of better things than we even anticipate now into 2021. The question on new markets, again, I think that piggybacks off of what we see here from a portfolio in this marketplace. There's a lot of markets out there that, India, Africa, a lot of those that have the potential, right? But all of these at one time had that potential too, right? So, we always go back to the growing incomes, right? So they're trading up protein. We know that that's happening worldwide. Population is growing, but now you throw a COVID on top of this, right? So I think that adds some uncertainty, at least on the trajectory of those growing markets. The one thing I wanted to add on those new markets, and I didn't put this in the full slides, but I think it's important to highlight here, is, so this is USDA's reported, so this is reported from packers, aggregated by USDA, the premium for beta agonist free. Now you'll see there's been some real gyrations here in 2020, and I fully expected this to go to zero, as we know, but with China not accepting and their rules on that. Now, that has declined at times and on average, but this market is still, there's still a premium for that. So that's not necessarily just a market access issue, as maybe some anticipated. Also here, there's still a large premium, and this is what shows up in that other purchase arrangement that USDA reports, and was the lowest, or was the price to see the least decline. Now it's a higher cost of production, because this is a lot of times the beta agonist free, or it's animal welfare, antibiotic free, so on and so forth. But here's a premium of roughly on average $5 per head. Now some producers are getting $25 per head, but that's probably the kitchen sink right on top of that. So, I think there's some opportunities for some value markets out there, not only domestically, but also as we talk about export markets too.
Great job, Dr. Schulz. We really appreciate your comments and answers to the questions. We've exhausted the questions and we've exhausted our time. So thank you everybody for attending. We'll see you next week at 7 o'clock.
I wish everyone well.